I think like a culmination of everything. Inflation is definitely playing a part. The froth in the market in terms of valuation definitely adding to why there is a certain amount of uncertainty today. But when you step back and kind of look at the market from, a different lens, the correction is barely anything. We're at 17,000 today, and we were at like 16,600 just about a month ago. And if you go back a year, we've rallied from 8,000 to where we are today. So for a market which has gone up 100, 150%, when it falls 10%, I don't think it's the end of the world. I wouldn't even like to categorize it as a big correction, but just like a tiny drop from the top. Well, I would be to actually value a company according to historic benchmarks. If a company is more expensive today as a multiple of its earnings than it has been historically, be circumspect, be cautious, and do not buy into companies which are really levered and expensive. There are a few issues on the economy standpoint, inflation being the number one issue. I think crude prices going up like they have is terrible for India. If you look at our fiscal deficit numbers last month at 14, $15 billion, we've had the highest fiscal deficit that we have seen in maybe 15 months in India. That is something one should worry about definitely. And also in terms of earnings, the last quarter, to be fair, has not been great. Uh, a lot of people are talking about how India is growing at 9% or 10% GDP, but uh, people fail to realize that, that is not in comparison to 2018 or 2019, which were actually bigger years than 2021. But we are comparing it to the pandemic duration, and I don't think that's a fair comparison. Uh, Cyclically, FIIs have been taking out money from India for the better part of the last 2 or 3 months, and that trend will probably continue. On a relative basis, I think India has become more expensive by virtue of all the interest we saw last year relative to China and our peer markets in the region. So I think some kind of a rebalancing of expectations is good. If the markets were to, maybe settle at, if we're at 17,000 today, if we were to settle at 14 or 15,000, I think would be par for the course in the longer run. I don't think that is something that one should worry too much about. Well, I've been skeptical on the new tech companies for a while now. Companies which are reporting, losses of 2,000 crores. All these companies tend to have a pattern. The year that they go IPO, they reduce expenditure and show a lower loss than one is normally accustomed to looking at. But notwithstanding that, next year, if these companies were to continue to lose 2,000, 3,000 crores a year, even to justify the 70, 80,000 crore market caps that they see today will become hard. Also, for the fact that, these are not monopoly businesses. There are other players. There are players with deep pockets. Like if you talk about, Nika, there is Amazon. If you talk about Zomato, there's Swiggy. Uh, Paytm has UPI. There is a lot of competition in this sector. So I would be circumspect to price these companies like tomorrow has already occurred. We are factoring in their growth trajectory for the next 5 years or 10 years, and we are pricing it like that has already happened. I think one should not do that. On the traditional stocks, I think Bajaj Finance, DMart, Jubilant, all these companies which have got ridiculous multiples today, even though they are extremely well run and they have a definite use case in the market, I think one would be better off shying away from these really expensive companies when things get bad. I mean, there's a lot that could be done. I have to talk from a trader come investor perspective, taxing derivative income at 43% of the max income tax rate, I don't think that makes sense. 80-90% of the trading volumes in India happen on derivatives. Uh, Nobody really talks about this, but it's very hard and unsustainable for an industry which is as competitive as trading, where people will stay, solvent for a long time paying that kind of a tax rate. STT, we've been kind of like, this sounds like a broken record because we've been talking about STT for, over a decade now, and I
Yeah.
don't think STT kind of like, helps anybody. That 15,000 crores that they collect out of it, I think they lose a lot more in terms of impact cost, in terms of how deep our markets are. Doing away with STD, I believe, will bring in a lot more foreign participation and a lot more domestic participation in the equity markets. Uh, at about 1,800 bucks a crore that they charge on the sell side, a retail guy who has like 5 lakh rupees in his account and is levered uh, pays an inordinate amount of STT. If you were to buy and sell the Nifty 5 times in a day, almost 1 point on every transaction will go just towards STT. That's like 5 points in a day. Considering that, it becomes even harder for a retail guy who is speculating to remain profitable in the market. We were doing this research paper and we realized that more than impact cost, more than losing money to brokerage and other charges, uh, all of this combined is lesser than how much a retail speculator in India loses in terms of STT. And these people are essential for the ecosystem. If you take away the speculators from the ecosystem, the foreign capital, all of that also goes away because our markets become quite illiquid and the cost of investing goes up significantly. So we should treat them as a cardinal part of the ecosystem, and we do really require them. So doing away with STT is probably something that should happen.